Hey there. How are both of you doing? You doing good, man?
Sir.
So have you been working on the things we talked about?
Oh yeah, absolutely.
Okay. So just get back on my schedule.
Okay. I'm gonna send you something.
All right. Send me something good, as they say. Send me something good.
Uh, what happened to the music, by the way?
Huh?
I said, what happened to the music? You
Oh,
want
you
me
know
to
what?
be
You know what? I was
kicking
gonna
back
put it
some
on, but I
70s
couldn't do
jazz?
too much. I'm
Okay.
playing a Les Brown video to get you guys
Oh,
started
okay.
tonight.
Yeah.
Miss Lee, how you doing?
I'm good. How are you?
All right. That's good. Get the first one. Denise is here. Let me let Denise in. Miss Powell.
Good evening.
Good evening. I was asked where's the music tonight. Instead of music, I decided since you guys are here first, I'm gonna go ahead and share my screen and share oh that didn't work right. There it is. Yeah. I know you guys remember Les Brown, right?
Absolutely.
All right, well, we're gonna hear a little old school Les tonight. All right. Oh, let me make sure I share the sound. Hold on. I'm gonna share sound. Huh. Can you hear it?
Not yet.
Not yet.
You couldn't hear it? Something's not letting me do it right. Hold on, we're gonna try it again here. Share. And oh man, it's not letting me share sound for some reason. But all right, I'll figure it out. Maybe I can bring it on later on.
Yeah,
Old school left.
click on the three dots. It's kind of it can be kind of tricky with the sharing sound sometimes. But
Yeah,
there
hold
should
on.
be
Okay,
three
I'll try it one more time. Well, we got time. Hold on. Let me see. Maybe there's something in the share settings. I don't know. I ain't gonna worry about it. Let me let everybody in and get started. Because I don't want to take up any of this young lady's time. Because she's gonna school you tonight. Hey, Chris, how you doing, man?
Oh, hey, Mark. I was jumping on as an observer.
Okay, yeah, that's fine. That's fine. That's good. That's good.
This is the procurement one, right?
No, this is the one on back office accounting.
Ah, okay. I'll hang out and observe.
All right. Okay. Good deal. Good deal. All right. I don't like to, keep you guys long and waste your time. So I really want to get started this evening. I have Raquel Lindy here. She's here. How do I say your last name? Landy or
Landy, yeah.
Landy? All right. She's our subject matter expert in the area of all things accounting. And she's going to run you through some things tonight about accounting for your business. And so as people join, I'll let them in, okay, but I don't want to take up any more time. And so I can't play my video. I'm gonna figure out if I can play my video, there will be a break. But so anyways, Kelly, you can take it from there.
Okay. Let me share. Can everybody see?
No, not yet.
Okay.
I can see it.
You can?
Yes. The foundations of financial success.
Yes.
How come I can't see nothing? But my computer maybe, I don't know. I can't share my sound. I cannot see. But I don't need to as long as something can all you guys see it? Chris, can you guys see it? I
Yes.
don't need to. If I don't need to see it, so don't worry about me then. Go ahead, do what you gotta do.
Okay. Well, my name is Raquel Landy. I run an accounting firm called Phoenix Rose Accounting in the Metro Atlanta area. I'm out of Gwinnett. Um, so what I'll basically be going over today is bookkeeping, accounting, the foundations of that, what financial reports you should look at, the profit and loss, balance sheet, and statement of cash flow, and how it works for your business. A little bit about who I am. I'm an enroll agent, which is a license that you get through the IRS and is focused mostly on tax law. However, I have a background in bookkeeping. I started off doing nonprofit bookkeeping and moved into for-profit bookkeeping a few years later. And then from there, tax preparation at a firm that focused on asset protection and real estate clients mostly, but they had a wide variety of clients. That's where I learned most of what I know. And then I went through and opened my business from that experience. So when mostly speak about bookkeeping, it's going to be through a tax perspective because a lot of times when someone is doing their bookkeeping or you hire someone to do your bookkeeping who might not be experienced with taxes, you can end up doing things or making mistakes that you could otherwise avoid if you had the knowledge in both areas. And the aside from just information for yourself, when you want to do your bookkeeping for your business, you also want to think about if I ever get audited, I'm going to have to give these financials to the IRS. Do they look like something I would want to give the IRS if the need arises? So, again, I've seen what it looks like for clients to not have proper bookkeeping, not been taking the proper steps to keep up with their finances, where everything is going, where their cash is going. They don't know what their net income is. They just know what the profit is for the business. And it can lead to some things that we don't want, like loan denials, IRS notice. If the IRS is asking for the financials and they don't look good, it kind of will put you in a position to now have to justify everything instead of the one thing they were asking about. So it's very, very important to keep all of that straight, and that's what we'll talk about today. So again, we'll talk about the cost of financial disorganization, bookkeeping 101, understanding your financial statements, cash flow, and why your profit and your net profit, knowing those things aren't enough, better financial habits, and then we can go through questions at the end. If, though, during any of the slides you have a question, I think you should alert me if you put your hand up, or you can just come off mute and say, I have a question, and I'll stop to answer it at that time. So, again, the cost of financial disorganization is 82% of small businesses fail, and the primary reason is cash flow problems. If you have a good product, a good service, it's amazing, but you're not keeping track of, is this feasible for me to run? How much am I spending in this area? Am I getting enough deductions or taking enough deductions? then you end up paying more in taxes than you need to. Your business can't afford to pay the back taxes that you owe, and it just kind of leads to a slippery slope. So, making sure your books are organized is a good way to stay away from that. A lot of business owners that I work with are now trying to get loans, they're trying to grow, they need capital, and the bank will ask, a lot of banks will ask for your profit and loss statement or certain years of tax returns, like the last 2 or 3 years of tax returns. And if those things aren't done right, then it could hinder you from getting a loan. Also, a lot of tax preparers, myself included, I know if they have to go in and do cleanup of your books, if you just hand them a bunch of receipts, if you haven't kept track of anything, if you don't have financials to give them, it costs more money for them to do the work for you. If you hand them or clean financials, one, you'll probably be their favorite client, and two, it will lower the cost of what you're paying because they don't have to do your bookkeeping, it's already done. So, some things that I hear is I'll catch up at tax time. When tax time rolls around, if you don't have an accountant that you're going to regularly, you're trying to find one, the last thing you want to do is also go through a year of transactions and figure out what you did, what each transaction was for, what category is supposed to go in. And then if there were deductions that you could have had, it's kind of too late. So I always like to tell people bookkeeping is, I would say it's more necessary because that's what gets you your tax return. If you have a business, whether it's a business that's disregarded to your personal taxes, what you're entering in most of the time is your financial statements. It's going to be your profit and loss. It's going to be your balance sheet. So if you know throughout the year the direction you're going in, there are no surprises. You aren't surprised by the fact that your net income is twice as high this year as it was last year, and now you're paying twice as much in taxes because you've been keeping track of it all year. So you've known to set this money aside. You know your business is doing better, which is an exciting thing, but again, you don't want to be surprised by that tax bill. And if you wait late to do it and you hire a bookkeeper to do it, they're going to have a lot of questions for you. What was this withdrawal for? When you went to Walmart, what did you buy? It's harder to remember those things 9 months later than it is month to month if you are doing the work or you have somebody doing the work for you. The second thing is I have a business bank account, so everything is good. Having a separate bank account is essential, but if you're spending out of your separate bank account, it doesn't meet on personal things, then you kind of negated the whole point of having a separate bank account. I've seen clients with Netflix subscriptions on their business, and their business has absolutely no reason to have a Netflix subscription. Or most of their income comes from their business, and so they use their business bank account, their business debit card, like a personal debit card. Once you start mixing those funds together, you open yourself up to the IRS saying, now prove to me that everything that you said is business related is actually business related. Because we can see this one thing is not. So when you went out to eat at this restaurant with a client, you have to start justifying these things. The burden of proof kind of falls on you to prove to them that all these other expenses are business expenses, even though these few are not. Another thing is I'm too small to need help, or I don't have a lot of expenses. I don't do a lot of business yet. I'm still starting up. So I'm just gonna wait until I get bigger or make more money to worry about this. But the thing is, when you get bigger, you don't have a system in place. So if your business is growing, that means it's clearly more work you're putting into it, more of a product you have to make, more of a service you have to provide, and generally that takes more of your time. If you don't have a system in place, then you're going to be working more in your business, but also adding more stress to yourself because you didn't take care of however you wanted to do your bookkeeping in the beginning. So, the best time to start is as soon as your business starts, as soon as you make your first dollar and you have your first bank account. Even if it's an Excel sheet, if you feel like I don't need QuickBooks right now or Zero right now, even if you just have a small Excel sheet where you keep track of every expense and what category it belongs to, it's better than waiting until your business gets bigger to try to figure out what system works best for you. The next one is because I'm have a profit, I have money. A lot of people, a lot of clients I have are surprised at their net profit that shows up on the profit and loss statement, which we'll talk more about. But a basic overview is it's your income minus your expenses. And they don't take into account things like withdrawing money from the business bank account or paying back a loan. Those things don't show up on your profit and loss statement. However, they are money coming out of your bank account. And what you're taxed on generally is your net income. So it is that number that shows up on the bottom. So a lot of times I hear this says I made $100,000 in net profit last year, but my bank account is negative. How did that happen? It's generally, again, because you're withdrawing money. The IRS doesn't count that as an expense. You still have to pay taxes on that money. Or you're paying back a loan. That's not an expense. The IRS is going to make you pay taxes on that money. So being profitable doesn't always mean your business has money, but whatever that net profit is, you are going to have to pay taxes on that. And then the last one is I can handle this myself. And again, a lot of times you can, but always make sure that it's worth the time that you're putting in. So if you're spending a long time doing it, it takes you 10 hours a month to do bookkeeping, and that's 10 hours a month you're not putting back into your business. So then you kind of don't want to do it anymore because you could spend this time better growing your business. That's how you fall behind. So you want to calculate it is what you want to calculate is this time I'm putting in worth it? What does it cost me to put this time in? What is my dollar per hour that I make? And then am I spending this time wisely? So when you're smaller, when you're starting, then yes, you want to be the one doing your bookkeeping. You want to learn what your books look like. You want to learn the expenses that it takes to run your business. But as you grow, it starts to make sense to outsource that, because if you're spending 10 hours again a month doing bookkeeping, then you're not spending 10 hours a month. That's 10 hours a month you're not spending growing your business, which you have to decide, is that worth it or not? So bookkeeping versus accounting. Bookkeeping is just recording everything every dollar in, every dollar out, any invoices that you pay, any receipts. Usually they have, again, with a bookkeeping software, accounting software like QuickBooks or Xero or FreshBooks, they have it where you can attach your bank account to it. It will pull all of your transactions in, and then you can, based on your chart of accounts, decide where each transaction goes, and it gives you the financial statements. Accounting is what you build on that. So that is then taking those financials, speaking with someone about it, or looking it over it yourself and figuring out, where am I spending too much money? Where can I do better? How is this going to affect my tax return? Am I big enough now that I need to be an S corp instead of a disregarded entity? Can I afford to pay a new employee? So your bookkeeping is kind of like the foundation of your house, and then your accounting is what you build on top of it. So without good bookkeeping, without good financials, then it's hard to see whether or not you can do better in a certain area or whether you can save. Again, bookkeeping, using those financials can help you come up with a business budget. It can help you set goals for how to grow your business. It can help you see patterns in your business of where it could make more money in a certain season versus another. And then again, with your accounting, that's now figuring out how that works with your tax returns, how that works with growing your business, and is there ways you can save? Is there things you can do to help grow your business with this information? And there's two types of accounting, or keeping track, I should say, of your business financials. And there's a cash basis, which is a simpler one, and the one I recommend for most clients and most small business owners. And that's when you record your income when you actually get paid, not when you invoice a client. And you record an expense when you actually pay it and not when you receive the bill. So if you invoice a client in December, but they don't pay until January, then that money wouldn't count towards December's income. It would count towards January's income. It's simpler, it's cleaner. You don't have to really mess with like accounts receivable and accounts payable, which could be more complicated. And that's usually, I would say, for larger businesses or businesses that invoice out months in advance. But if you're small, I would say stick with cash basis. When the money comes in, you record it. When the money goes out, you record it. Accrual, again, works differently. You record the money when it's earned, meaning you record it when you invoice the client, whether or not you actually have the money. And the same with expenses. When you receive the bill, whether it's paid or not, you record the bill that way. It also gives you the ability to have prepaid expenses. So if you pay your insurance up for a year, then you can record that as a prepaid expense. It shows up on your balance sheet, and then each month you would deduct from it as an expense onto your profit and loss, which is more complicated and not really that necessary. So I would say that's more for businesses bringing in millions of dollars in revenue, and those things kind of matter more if you're looking for investors or you need like a formal financial review or business valuation. That's when you want to look into accrual basis for your accounting. But if you're not there yet, cash basis is the simplest, easiest way to do it. And once you pick a way, you want to stick with that because it's a little bit complicated to switch later. So until you get to that, like a point where you need to switch to a accrual basis, I wouldn't worry about it. So what bookkeeping normally goes over every month is your income and your sales from your business, your expense categorization, bank reconciliation, which is something a lot of people who are doing their own bookkeeping don't do and should be done. And that's, again, whether you have an accounting software or not, if you have an Excel file, you can still reconcile your bank account. And by reconciling your bank account, that means I took the income or the amount in my bank account at the beginning of the month and then added all the income I received, subtracted all of the expenses, and now the number I have matches my bank balance at the end of the month. If it does not match, then there's a problem and you need to go back and figure out why. One of the most important things you want to do when you are doing your own bookkeeping is making sure you reconcile your bank account every month. With a lot of the accounting softwares, they will have somewhere you can go to put in your bank balance and they pull everything that went through that bank account. And they will tell you if it matched or not. They'll tell you how much you're off. And then a lot of times now they'll have like a suggestion of what it could be, or once you have that amount, you can go search for it and see if you can find it. But if you're not using an accounting software yet, you can still do it yourself. Again, if you have multiple bank accounts, you would just take all the income that went into that specific bank account, all the expenses that came out of that specific bank account, and it should match exactly what's on your bank statement, and your ending balance should match exactly what's on your bank statement. And if it doesn't, you have to figure out why. Again, if you want, oh, go ahead. If you have accounts receivable and accounts payable, you want to keep track of that. And again, you'll generally have that if you're using accrual-based accounting and not cash basis. You want to keep track of any mileage for your business that you drive. They have a lot of apps for that. I think the most popular one is Mile IQ or Mileage IQ. And that's for if you're driving to a job for your business or back home, or if you're driving to pick up supplies for your business and back home, or if you're driving to meet with a client for your business and back home. So those things count as business mileage too. And your home office deduction, there's two ways that you can do your home office deduction. One is they have like a standard method where it's $5, I think it's still $5 per square foot up to 300 square feet, which is $1,500. Or there's like a more tedious way, but it gives you a bigger deduction where you keep track of all of your utilities, repairs, landscaping, all that done to your home. And then you take that number and divide it by the size of your home office. So if your home office is 10% of your house, you would take all that you paid. So all of your utilities, all of your landscaping, all of your repairs to your home, and then divide that by 10%, or take 10% of that and you would use that as a deduction instead of the $5 per square foot. And then you want to keep track of any payroll records. If you have payroll, any taxes that you paid, any wages that you paid out, make sure that they match the payroll statements that you received, because a lot of times the way they come through your bank account does not match the way that the payroll company does it. you have to kind of do some adjusting to make them match and make sure that the taxes are going into the right category and make sure that your tax liability is going into the right category. So having payroll records can be a little bit more complicated, but you just want to make sure it matches the way it's coming in, or make sure it matches what's on your payroll statements each month and not just the way it's coming in. So good bookkeeping is not just organization, but is keeping everything in your financials matching any type of proof that you received. So again, from your bank, from your payroll company, making sure all those things match what you're reporting so that there are no discrepancies in case you ever need to give that information to anybody other than yourself. And like I spoke about before, when you are choosing what category your expenses go into, it will be on your chart of accounts. Your chart of accounts has 5 main categories. Your assets, which are things your business owns. Its bank accounts is generally larger items over $2,500. Any equipment, things like that. If you have rentals, houses, if you have a really expensive computer, you can list that as an asset. Your liabilities, which is what you owe people, credit cards, loans. If you have payroll, it's your payroll tax liability will be on there. And then equity is your ownership, your stake in the business. So it's money that you put in and money that you took out. That will be kept track of in your equity account. And your equity accounts change generally based on the type of business that you have. So if you have a business that's disregarded to your personal taxes, then it's usually just owner's draw or owner's equity. If you have an S corp, a lot of times it's shareholders distribution or additional paid in capital. If you have a partnership, it's a different one, capital contributions. So your equity account depends on the type of business that you have, and you can pretty much, if you don't know what it's supposed to be, you can Google it to figure it out, and it'll give you an answer that's probably passable enough to get you by. Another category is your income, which is your revenue, and your expenses, which again is all the cost of running your business broken down by category. If your chart of accounts is built correctly for your type of business, then it can be amazing. But if you don't know where things should go, or if you have something listed as an asset that should really be an expense, or like maybe you have like a $500 cell phone. This is just things that I've seen other clients do, and they have it listed as an asset. It's not big enough to be depreciated. It should just be an expense, something they pay for, and maybe go to supplies, but it can clutter up your chart of accounts. I've also seen people do things like be too specific. So instead of having supplies, they have Walmart supplies, Target supplies, Amazon supplies, and then things like that. You end up with a 5-page profit and loss statement, and it's hard to read. And if it's hard to read, then you don't want to read it. And at that point, it's not helping you. So you want to make sure you have a good chart of accounts that's simple and generic enough that you can read it, you can understand it, but also you're not missing out on any deductions, or you're not putting things together that shouldn't be, like travel and insurance. Those should be 2 separate categories. But it's up to you if you want to break it down by liability insurance, business insurance, health insurance, if that's something that your business can pay for you. And if you did sign up I know like QuickBooks and Xero, they have a basic chart of accounts already in there that works for most businesses, and then you can adjust it if you want to, or if you are, again, still smaller and you are using an Excel file, there's an easy way for you to be able to choose like a drop down or make where you can choose a drop down and make sure all of your accounts match. So it's the same every time. So there's not a situation where you accidentally like misspelled something and then if you try to create like a table from it later, it kind of throws you off. I actually have a bookkeeping Google sheet that I can put in the chat.
Let me make sure I open the chat up right. I may
Okay.
not have, I'll do that right now. Hold on. Make sure everybody can see the chat. No, I didn't do it right. I hadn't set it up right.
And
Now everyone should be able to see. If you say to everyone, they'll be able to see what you put in there.
okay, let me pull it.
I don't see anything yet. Oh, there it is. I see it.
And then let me drag this over. If you go in and you want to use it, you can click File, Make a Copy, name it whatever you want to name it, and then once you click Make a Copy, it'll make a copy for you with whatever you choose to name it, and then you'll have it so you can make adjustments to it. But it'll help you keep track of your income, keep track of your expenses. Then it'll give you an annual overview and a monthly overview of where your business is so you can look at that. And it has a drop down so you can change month to month so you can see where everything is. As long as you put the correct date in, then it'll show up in the correct month. Just sharing the right screen. Do you guys see my screen still?
Yes.
Okay. So the next thing that you want to do once you have all of your income and your expenses being tracked is look into your financial statements. The three most important financial statements are your profit and loss, which is did you make any money? How much money did you make? And how much did you have left over after all of your expenses? Your balance sheet, that shows what your business is worth right now. What do you have versus what do you owe? And then your statement of cash flow is can you actually pay your bills? And do you actually have money in your business to be able to sustain? And they all are very important because a business can look really good on a statement of a profit and loss, sorry. But if you look at your balance sheet, you realize, oh, I have a very large loan that my business owes. Or if you look at your statement of cash flow, you realize you have more money going out than you do coming in. So you really need all three of those financial statements to be able to give you a good picture of your business and how it's running, what it looks like, where you're at. So here's an example of a profit and loss. You can see it's just a sample company that offers consulting services, and they brought in 142,500 coaching, and then work income, and then workshop income, and then that gives you your total revenue. And that total revenue is your income before anything is subtracted from it. And then you have another section that can be called cost of goods sold or cost of services. If you run a business that sells t-shirts and you have to purchase bulk t-shirts, that would be there. If you hire contractors, if you have a specific software that you have to use, that goes there. Any things that like supplies or materials that you have to be able to run your business or to be able to sell your service or sell your product, that generally falls under cost of goods sold or cost of services. And then you have your regular operating expenses, which can be your salary, your payroll taxes, rent, marketing, anything that it costs, again, to keep your business running, but is not, I wouldn't want to say not absolutely necessary, but it is not directly tied to the service that you provide. Another one is loan interest. So while the principal balance or the principal that you pay towards a loan is not deductible, so it doesn't show up on your profit and loss, and you have to pay taxes on that money, even though it's technically not in your bank account. You can deduct the interest that you pay on a loan. So that's another thing, another expense that your business can have that you can write off. Again, if you have meals, it's not listed, but if you have a business dinner with a client, that's something that is deductible, but is only deductible generally at 50%. So a lot of times you hear people saying, oh, you can take your client out to a fancy meal, it costs $500, you can deduct it. It's only deductible at 50%. And at the end of the day, you have to make sure it makes sense for your business. So it doesn't, if you're not going to already spend the money on something like that, that's one of those things you don't want to go out spending unnecessary money on if it wasn't something you were already planning to do, because it's not that helpful in the end. And then your net income is here at the bottom. That 79,000 is this income minus your cost of goods sold or your cost of services, your operating expenses, and any other expenses like this loan interest. That number is your net income. Again, it doesn't take into account anything like credit card payments. That's not factored in here. Loan payments is not factored. Any equity, any money you pull out of the business and put into your personal account, that doesn't get factored into your net income. Those aren't expenses. They do show up on your balance sheet, and it is money that comes out of your bank account. But since it doesn't count as an expense, it doesn't come out of your net income, and you still have to pay taxes on that money. So again, your profit and loss shows you different areas. The key line items are your revenue, cost of goods sold, Your gross profit is here. That's your revenue after the cost of goods sold. And then your net income or net revenue is after the everyday operating expenses. So you start at the top line with the revenue, subtract the direct costs to get your gross profit, then subtract your operating expenses to get your revenue. And one common mistake that people can make is, again, focusing on your revenue. Oh, my business brought in $100,000 last year or $250,000 last year, and not looking at everything that you had to pay to be able to make that money. And again, because things like loan payments, money that you took out, or credit card payments don't factor into this, your net income can make your business look more profitable than it is, or look like you have more money than you do. And a lot of times, business owners don't have $79,000 in the bank. So they see that and say, where did that number come from? I don't have this money in the bank. How did you get that? And I have to explain to them, because these things aren't factored in, you should look at your statement of cash flow, and that will give you a better idea of where your money is going. And so the next financial statement is a balance sheet. This is the one a lot of banks look at when they want to decide whether or not to give you a loan, because that's going to show everything you own. So all the money in your bank accounts, any assets that your business owns, and then everything you owe to somebody else. And then the equity, which is generally the difference between the two, and that's your stake in the business. Assets, if done correctly. So if you have an accounting software, normally it will make sure that this happens for you, but your assets must always equal liabilities plus equity. So if it doesn't, then something's wrong. If you're doing it on an Excel sheet and your assets don't equal your liabilities plus your equity, then you have to find where everything went wrong. It's a balance sheet. It's called a balance sheet because it has to balance. And if it doesn't balance, then there's a problem and you have to go back through and figure out why. So here's an example of a balance sheet, and this is what I mean when it says your total assets has to equal your liabilities plus equity. And if there's something missing, if there's something not accounted for, it generally gets put to equity to make it balance, but you shouldn't do that. You should figure out what happened and how you can fix it to make sure it balances. So again, this is a balance sheet for a fictitious company, Bright Path Consulting. This is all the money they have in the bank. This is a savings account that they have for tax payments. This is, like I said, if you have accrual-based accounting, then your accounts receivable, which is the money people owe you, counts as an asset. And then any prepaid expenses. So again, if you paid your insurance up for the year, then you would list it as an asset. And then as each month goes on, so if your insurance was $100 a month, each month you would deduct $100 from that asset as an expense on your profit and loss. But I don't recommend doing that accrual accounting because it can be very complicated. And then any assets you have. So if you have a really expensive laptop that costs $8,500, you would list that as an asset. And then each year you would depreciate that. So it would show up that depreciation shows up as an expense on your profit and loss. So if, for instance, if it's depreciating at $2,100 a year, each year you would take $2,100 from this 8,500, and then at a certain point, they would balance out where it was $8,500 for the asset. You have $8,500 in depreciation, and that number would be zero because at that point it's saying that asset is worthless. You have taken all of the value of that asset as an expense already. And the reason the IRS has that where you can have things over, or you should have things over $2,500 as an asset and not an expense, is because a lot of times when you're starting a business, you have to buy a lot up front for your business. And purchasing those things costs a lot of money, especially if you have, like, if you are somebody who does rentals and you purchase a property, it keeps you from taking that full deduction all at once. So if you purchase a $250,000 house and you try to list it as an expense, then you're having a $250,000 expense, but you might only have $100,000 in income, which means now you have your business operating at a $150,000 loss, which can work for the first year. But then it kind of leaves you in a bad spot for the next few years. And all of that money then that you're making is going towards your net income. And you lose that deduction for the house because it's all up front. So you have that, I guess, buffer in place where if it's over $2,500, it goes on the balance sheet, it gets depreciated over time. So also certain things have different lifetimes. So a property is generally over 27.5 years. But something like a computer can be 3 to 5 years depending on really how you want to do it. Because nobody's going to keep a computer for 27 years, so it makes no sense to have the depreciation go out that long, because after a few years, people generally sell computers and get new ones. And right now, I think they have the bonus depreciation back at 100%, which is like it's probably not necessary to get into, but certain things you can depreciate at 100%, but we'll move on from that. That might be too much. But here's your liability. So your accounts payable, if you did the accrual method, would be a liability. That's money you owe people, bills that have come in that you haven't paid yet. Your payroll tax payable, that is a liability. Your credit card balance is a liability. And any debt, any long-term debt, a loan that you have, that's listed as a liability. And so instead of payments being towards these things, like being listed as an expense, like your credit card balance and your long-term debt, it actually goes to your balance sheet, and then it lowers that number. So if you pay $500 towards a loan, instead of being an expense, it'll go towards the loan balance, and then your loan will be reflect $3,100 instead of $36. And then again, any equity that you have. So this owner's capital is money that was put in. Owner's draws is money that was taken out. And then your net income counts as equity, and that should always match. If you're doing it yourself, it should always match what is on the profit and loss. So how here we had 79,000, it's $79,000 here. And then all of these together should equal the assets that you have. Does anybody have any questions so far?
I don't see any hands raised.
Okay. So the statement of cash flow is, again, where it shows where your business truly stands, and it shows how the money is moving in and out of your bank account. So, for example, if you have a large contract come in October, you do the work in November, you send the invoice in December, and your client pays you in February. If you are on an accrual method, you might have that income showing in December, but your bank account doesn't reflect it until February. If you're on a cash basis, then you don't really have to worry about that. And then your rent and insurance and everything comes out regardless of when the money's paid. So rent for October is going to come out, rent for December or November, December, it's all coming out, even if the money doesn't show up till February. So the gap between what you earned and what you got paid is where your cash flow comes in. A lot of businesses have a struggle with that because, again, even if you get the contract in October, you don't get paid until February, you still have to keep your business running. Things still cost money. The money's going to have to come from somewhere. And that's where a lot of people see they're having to put their own money into their business, their personal funds into their business to be able to wait out those 3-4 months until that money actually comes in. 82% of businesses fail due to cash flow problems. That's not obviously a business problem that we want to have, and most businesses can only survive about 45 days without income. Once you start landing larger clients, if you're doing government contracting and things like that, sometimes it can take you a while to get that money paid out to you. So you want to make sure that you're in a good place when that happens. You want to know what your bills are. You want to have a budget in place. Again, you're having your bookkeeping done, having your books together will be able to help you navigate that when the time comes, if the time comes. So understanding the cash flow statement, which we'll look into, is generally broken into 3 sections. Your operating activities, which is cash generated by your business day to day. So that's payments coming from invoices, vendors, and things like that. Investing activities, so your long-term assets, any property you have, any vehicles you have. And then your financing activities. So cash coming from outside sources like a loan or anything that you take out, your owner's draw or shareholder distributions. Those would show up in those sections. And then once you add all 3 of those together, it will show you where your business stands from a cash flow statement. Here we go. So here with, again, the Bright Path Consulting, under your operating activities, you have your net income of $79,000. And then you have that depreciation, which is an expense. So it will take that depreciation from that 79,000. And it'll have all of your deductions. Like if you had an increase in accounts receivable, if you have an increase in accounts payable, all of those things are added into your operating activities. So clients that can owe money don't show up on your profit and loss, they show up on your balance sheet and they show up on your statement of cash flows. And then after the adjustments, it will give you the net cash from your operating activities. And then your investing activities, this is again any purchase of assets that you have, it does show up as a negative because you paid that money out and it's not going to show up as an expense because it's on the balance sheet. So it shows up coming out of your statement of cash flow. And then a business loan is kind of again the opposite of what's on the balance sheet. It's going to show as a positive because technically that's money going into your bank account. And then the loan payments are going to show up as a negative because that's money coming out of your bank account. So all of the money going into your bank account on the statement of cash flows, whether or not it looks different on the balance sheet, shows up as positive, and then all of the money coming out, even your owner's draw and everything, will show up as a negative because it's money coming out. And then the cash at the end of the year should match, if everything is done correctly, what is on your balance sheet for cash. So those two numbers should be the same. Whatever your bank account balance is, should be the cash at the end of the year. Or, yeah, the cash at. And then your cash at the beginning of the year should match what you started the year with if everything is done correctly. So 10 cash flow red flags. This is how you know you might have an issue with your cash flow, is using personal funds to cover business expenses, relying on credit cards to make payroll, paying vendors late because you don't have the money, turning down work because you can't afford upfront cost. You don't know what your balance will be 30 days from now. It's unpredictable. Things are coming out that you don't remember. Your biggest clients are paying you 60 to 90 days after you're invoicing. You can't pay yourself, so you're basically working for free, or you're taking out loans to cover your operating expenses. You're feeling anxious every time your bills are due. All of those are things that are red flags. If you are going through any of that, then you have to now start to come up with a plan to improve your cash flow with your business, whether it's coming up with a business budget, whether it's coming up with a plan to restructure how you're invoicing clients. Those are things that you need to think about if you're facing any of these things. So some strategies that you can use to improve your cash flow is sending the invoice the same day that you finish the work. So if you're waiting till the end of the month to send all your invoices out, or the 15th or something to send all your invoices out, then you're letting the money sit. And if you can afford to do so, then feel free. But if you can't, if you're having any problems, then you want to look at how you're invoicing and make sure that that invoice goes out immediately instead of later. Another thing is to require a deposit before you start work. I'm not sure if with government contracting, I don't do any of that, so I'm not sure if you're allowed to require a deposit or not. I know for me personally, if I am doing work for a client as far as tax preparation, I always require half of the cost to prepare the tax return up front. And then the other half is generally due once the return is completed, the client approves it. And then before I file it, I require the other half to be paid. Because especially when you work in industry where you're doing a service for somebody, it can be very easy for you to complete the service and the person decide they don't like it, they don't want to do anything with it anymore, they change their mind or just disappear, and then you have to wait forever for your money. So for me, with tax preparation, I require 50% upfront. My husband DJs, and when he has a client, I think he does 25% upfront because there have been plenty of times where the client will wait till the day of and say, never mind. But you block that day off, so you couldn't take another job on that day. And also, I've seen once people pay a deposit, once they've given you some money, it's a lot less likely that they'll cancel or decide they don't want to do it anymore because they've already invested in your service. So, especially if you work in a service, I will highly encourage everybody to require some sort of deposit. Also, shorten your payment terms if you can. So, if you have a contract where you guys previously agreed upon net 30, then continue to do that. However, if you don't, try to do net 15, net 14, something like that, net 7 for, again, for depending on the service. For some of my clients, I'll do net 7 if you're just starting with me, or if it's essential urgency, I do tax preparation again. So if you're coming to me on the 13th and you need your taxes done, I'm gonna have to generally file an extension for you. That takes time, that takes money. I need that by the 15th before I'll file the extension. So you decide what works best for your business. It does not have to be net 30. If you're sending out an invoice, you can send an invoice that requires payment upon receipt. Again, that's if you have a service industry business, or if you're in the service industry. If you sell a product, of course, people have to pay for it immediately, most of the time. But if not, if you have anything where you're invoicing somebody, look at the payment terms. You can also offer a small discount for people who pay early. So maybe 2% off if you pay within the first few days that it's sent. You want to make sure you're building a cash reserve. So you want to have 3 months of operating expenses saved up. So every month you contribute to it like it's a bill, it's a non-negotiable, you work it in your budget to build that savings so that if you do have a contract that comes up where you aren't receiving the money for 45 to 60 days, then you have that money to be able to cover that time. Negotiate terms with your own vendors. So you can, on the opposite of shortening your payment terms, you can see if vendors that you work with will extend the payment terms for you. So maybe ask for 45 to 60 days for net 30, net 45 to 60 days instead of net 30 if you're paying that. It doesn't hurt to ask, and the worst they can say is no. And then follow up on overdue invoices. So don't just let overdue invoices sit unpaid. After it's been like a week, 2 weeks, a month, start or send emails, send reminder emails. Have a system, set up a system, stick with it so that people are constantly being reminded. And if it's a habitual problem, add a late fee. If you have a client that's constantly late every single month, just let them know, hey, this is a problem for you. Now, if you get past 7 days late, you have a 10% late fee or 5% late fee added to your bill. And that will motivate people to pay on time. and then build a cash flow, a 13-week cash flow forecast. So map out every dollar coming in and every dollar going out for about 90 days. And then once you see what that looks like, how that feels, then you can make proactive decisions instead of reactive decisions. And then the last thing is have a savings account for taxes. So a lot of clients that I work with don't pay estimated taxes every quarter. And then as soon as they file their taxes, they realize, oh, I owe $35,000. I don't have $35,000. How do I pay this? A lot of times on the previous year tax return, you got like an amount that you should be paying over every quarter for the year so that you don't end up with that problem. But I want to say 9 times out of 10, people don't pay that, and then they're surprised every April. Where did this money come from? How am I supposed to pay this? What am I supposed to do? And then you're setting up a payment arrangement for 2025 taxes in 2026 when you should really be making estimated 2026 payments so that in 2027 you're not doing the same thing. If that's the cycle you're in, you want to get out of that as soon as possible because you're basically always a year behind. And it just keeps growing. So if you set up a payment, it is an option to have a payment arrangement, and I encourage it, especially if you can't pay all at once. But also keep in mind that that very next year, there are going to be more taxes due, and you're going to have to figure out how to pay those. So it doesn't stop, it doesn't go away. So here's a quick financial routine that can help your business, help you keep track of anything going in and coming out. Every day, 5 minutes. If you have QuickBooks, log in, categorize what you did the day before. If not, log any income you received, check on any outstanding invoices that you have, see if there's another email that needs to be sent. Do you have another invoice that needs to go out? Did you just finish working on something you need to send an invoice out? So that's just something you do every day. Check on your income. And then every week, spend some time categorizing your transactions for the week. Look up and see if, again, is there anything that I need to pay that hasn't been paid? Are there any bills that are about to come out that I forgot about? Make sure there's nothing that's going to surprise you, because that's the worst. Feeling like you have money and then having a surprise bill come out can be very discouraging. And then every month, make sure you're reconciling your bank account. So again, if you don't have an accounting software and you're using any type of Excel sheet, Google sheet, still make sure you're reconciling your bank account, reconciling your credit card statement. So where it was on the balance sheet, where it showed that the credit card was $1,500, that number, this number, if you have accounting software, should match what is in your checking account. This number should always match what's in your statement or your savings account. Your credit card balance, that should always match what's the ending balance on your credit card statement. And your business loan balance should always match the ending balance on your loan statement. Same thing with the payroll taxes payable. Everything on the, generally, everything on the balance sheet should have some sort of documentation that you can look at and make sure it matches. And if it doesn't, of course, figure out why. And then once you're smaller, when you're smaller, I would say every 2 to 3 months, pull all your financial statements, compare what actually happened to what you budgeted. look over your pricing, look over if there's anything you can change. If you have, again, you should have a business budget. Look over if there's any adjustments that need to be made. If you have payroll, file your payroll taxes, unless you have a service that does that for you. Once you get bigger, then reviewing your financial statement should happen every month. And then annually, again, you want to make sure all of the things on your balance sheet matches all of your statements. Make sure you have enough set aside to pay your estimated taxes by April 15th. Look over your budget, make sure it actually worked for you throughout the year. Look for any patterns through the year where your income might have been lower or higher to help create your budget for next year. Make sure you weren't commingling funds, and if you are or were, they're in the right place. So you don't have your Netflix subscription under subscriptions on your profit and loss. And it's actually listed as an owner's draw because it's money you took out for your personal business. And then again, things that can help. QuickBooks Online, Wave Accounting is good for small, simple bookkeeping. I think they have a free, I'm pretty sure they have at one point they had a free software or a free plan. Xero is good for bookkeeping, and they have, if you're smaller, one that's like only $10 a month. FreshBooks is good for invoicing and time tracking, because another thing you want to do is track the time you spend on product or projects. So whether you are making a product, selling a service, track the time that things cost you to do so that you make sure that you're pricing accordingly. If you're underpricing, if you're spending 10 hours to make a custom shirt, but you only charge $25 for it, at that point, it's not worth it. And if you continue to underprice yourself, then it makes running your business not fun anymore, and then it will make you not want to do it anymore. So that's something to look out for. QuickBooks is kind of what everybody uses, most people use. Connects to your bank account. It has the option for payroll. It has a lot of good financial reports that you can pull from it. And Dext or Hub Doc, that's where you can take a picture of your receipts and it gets categorized and uploaded automatically. It's not really necessary if you have any of these accounting softwares because they can connect to your bank account and it's pulling in the purchases that you made anyway. And then Gusto and ADP run your payroll for you. They'll file, usually if you have the correct plan, they'll file your payroll taxes for you. And they'll give you the ability to pull your statements every month to decide or to reconcile again against those statements that you have. And then just a quick when you should do it yourself or when you should hire a professional. So if your revenue is under $50,000 a year, you can do it yourself. If you don't have any employees or contractors, you can do it yourself. And if you have the time. Once you start to exceed, I would say $75,000 to $100,000 a year, you should probably start looking for help because generally there are deductions that you probably have that you could be missing. If you have payroll or employees, I would say definitely look into having a payroll software help you if you're not good at filing your quarterly payroll taxes, or you might need 1099s at the end of the year to give to contractors, look for assistance with those things. And then if you haven't already, here's some things you can do this week just to help you get on track. So if you don't already have a business bank account, do that immediately. It's very easy to open one. A lot of them, you don't even have to have like an initial deposit. And if you do have one, download your last 3 months of bank statements and review your transactions just so you know where your money is going. You can use the Google Sheet that I sent you, but enter those in so that you can start building out your spreadsheet to see a glimpse of an overview of how everyone or how everything is working together. And if you don't set aside or already have a savings account, then open a savings account to start not only building those 3 months of expenses, but also set aside that tax reserve savings. And that's it. Does anybody have any questions?
I see one hand raised, Denise.
Hi, yes. Actually, you sort of answered the question. I guess I would probably have to, it may depend. But I was gonna ask, what percentage of, as far as personal, my like it when I earn personal income from my business, what percentage you said like establish like set aside savings for that?
Mhm.
What percent of it percentage would you recommend of the income that I should kind of hold in reserve for paying quarterly taxes?
I would say you should probably start around 20, as much as you can. If you can do 25%, I would say that. If not, then do as much as you can.
Okay, okay. And then thank you. And then if I pay contract employees,
Mhm.
what amount of their income do I need to like make sure that they get a 1099 at the end of the year?
So I'm pretty sure it's $600 now.
Really?
Yeah. So if you pay them anything over $600, they need a 1099.
Oh,
It is $600.
oh, okay. I thought it was more than that. Okay. Thank you.
No problem. Anybody else?
I don't see any other hands raised, other than me. You're so informative. Yeah,
Yeah.
that was amazing. Yeah,
I-
that was a lot of good information there. I always like it when I learn something. Um, so I did have a question. What was I going to ask you? I can't remember what it was. Now that was good stuff. So, I think everybody's good. I don't see any other hands raised.
How can we get in contact with you if
Oh, she's one of our coaches. So
oh,
if you,
yeah.
that's why I sent out that coaching request. If you say CPA or accounting, I'll be sending you to her.
Oh, okay, thank you. Okay. I
All
screen
right. So
yeah.
all of you should have received that request, that coaching form today. And if you didn't, it's on any email that I've sent you. I'll send it to you again. But if you click and you say CPA or accounting, she's going to be who I match you up with. So, all of you should go ahead and click on that and fill that out and get it while they're getting good. So, but yeah, a lot of great information. So with that said, I don't have any other questions. I'm gonna let you guys go. Thank you, Miss Mandy.
No problem. And I
And
put a link to my website, the
oh
resources
yeah,
from my website.
yeah.
So it has other things on there, like a business budget spreadsheet and a chart of accounts spreadsheet that you can look at. And they're all free. So if you click the link, like if you click on anything on there, you should be able to download or it'll pop up as a Google Sheet where you can make a copy like I showed you with the bookkeeping spreadsheet.
So make sure if you do have more questions that you may want to ask her that are more intimate versus asking them during this session, make sure you fill out that coaching request form that I sent today. Say you need to meet with a CPA. I can't remember what I have it designated as on that form, but I will make sure to connect you with her. So with that said, I'll let everyone go. Thank you for your time. And I'll talk to you all next. Now, I was going to send out a survey over, you have about 4 more sessions. And I think I know it. I'm going to make those 4 more sessions. I think might be the most impactful. But I may send out a poll to you so we can all decide as a group because we have some flexibility. So I'm going to, I may just send a poll out, see what everybody thinks that they need. But take advantage of the coaching. With that said, I will let everybody go. Have a great evening.
You too. Thanks.
Thank you
Bye.
so much. This is great.
Thank you. Thanks. Bye.